Hi, folks. Dan Bird here with the Daily Scan for the 22nd of January. And because we had the day off, I forgot that yesterday was Tuesday. Kept thinking it was Monday. So we're going to do a technical Tuesday today on Wednesday, no less. And we're going to do it on chart patterns. So stay tuned. I've got a lot to cover, so I want to get to it as quickly as we can. Again, I'm not a financial advisor. Anything I say is for educational purposes only. You have to take your own responsibility for your trades, and past performance does not guarantee future results. So let's real quick look at the market, and you can see on the market bias, it went up again today, moved a little bit higher. Here's the NASDAQ. Not quite back to the highs, but it's getting there. If we look at the S&P, however, the S&P actually intraday went above 6,100. So it did actually make a new intraday high, but it did not close there. And unfortunately, it left us with a shooting star candle. So I expect the market to probably go down tomorrow. So we'll see. Probably it could actually be making a double top right here. We're going to see what happens, but the best thing is for it to break out finally out of this resistance level, which means it will probably continue higher. But that candle is usually a reversal candle. So I'm expecting tomorrow probably will be some selling going on. Let's look at Bitcoin real quick. And I think Bitcoin went down today. Yeah, pulled back a little bit today. We'll get a closer view on that. If we look at it on the market bias page, you can see S&P right here. You get a better view of that shooting star candle after breaking out. So that could be a failed breakout. And if we look at Bitcoin near the bottom, we see that it pulled back a little bit today as well, right after hitting resistance. Remember, I said this yesterday, actually 2 days ago as well. I said it's gone above this level, 106, quite a few times, but never closed above it. So it made it to 108. It actually made it up here to the high was 109 on the 20th, but has not closed above that level. So, and it didn't do it again today. So that might be perhaps heading back down too. So we'll see what happens tomorrow. All right. Let me real quick go through the market. Let me close these and we'll take a look at market carpet. So Microsoft and NVIDIA both had nice days today. Apple tried to stage a comeback. Apple's been going down quite a bit. Tesla continued to go down, and Berkshire went down. But these two, and actually most of the Magnificent Seven, actually are hanging in there. Netflix was the top of the list over here on the right-hand side. Arista Networks is up there too, as is Oracle. So big tech cap, big cap tech names look like they're supporting the market once again. Now let's look at the relative rotation, and you can see there's discretionary, there's communication services. Technology is trying to make it up into the leading sector, but everything else is heading down to the lower left. And a lot of things are already there, mostly the defensive, which you actually want to see if the market's going to go higher. But most of those and everything else is starting to head that way. So if everything starts moving right into this lower left-hand quadrant, then the market is going to have a hard time going up. These are the sectors for today. And here's the S&P. So above that are aggressive sectors, technology at the top, NASDAQ 100, and communication services. And then everything below it underperformed the S&P today. And if we look back 1 week, we can see technology for the week did well. NASDAQ 100 are up there, and industrials. So that's what it looks like so far. And if we look at the 10-minute chart, which is on the charts page, right down here, just to see what the overall market did. You can see it went up and then it went sideways, and it looks kind of like it's curling over. So again, I think tomorrow is probably going to be some selling. We'll see what happens. There's technology. You can see on the 10-minute chart, just today, really, it outperformed everything else, and it makes up 32% of the overall S&P. So that's the one that's holding things up right now. We'll see if that can continue. But things aren't looking too good in the short term. Now, this doesn't mean get out of everything and sell everything. It just means in the short term, we're probably going to have some selling tomorrow. We'll see. Doesn't mean we will, but we might be. So if I look at the dashboard, there's most of the indexes look pretty good. The VIX pretty much flat for the day. Bonds, 20-year went down slightly. You can see it right there on the left. 30-year went up. 10-year went up slightly and then pulled back at the end of the day. Commodities, there's gold, went higher. Silver went higher and then pulled back at the end of the day. And crypto, there's Bitcoin. So Bitcoin was up yesterday and then pulled back most of today. If we go down and look at the industry groups, we've got discretionary, technology, discretionary. So all aggressive sectors until we get to general retailers, number 9 on the top 10. That is a defensive sector. And then again, we have discretionary. So all of these are aggressive sectors over there. And in our top 10, we've got this one starting to make a comeback. There's Netflix, number 3 on the list, big black candle today. So went up and hit 1,000 and then started pulling back. Powell continues to go higher, but pull back at the end of the day. So that could be a failed breakout right there. There's Arista Networks, gapped up, continued going up, go one level down. Here's Palantir, continues to move higher. Credo moved a little higher today as well, and NVIDIA right here. It's in the top 20 of the list. So all of that looks pretty good. And at the end of the list, just take a look at a couple of them. DJT went down today. Here's a hardware stock. So those are the ones that are on the bottom of the list for today. Quantum, another quantum stock right there. All right, so that's it for the general market. Let's do technical. I'm going to do one more thing because somebody asked me to take a look at some stocks. So here's KMI, and just 2 of them right now today. I'll look at it on the this view right here. One is KMI. KMI actually reported after the market tonight. And right now it is down slightly. Let's see what it's doing. No, it's up. It's actually up. So but still kind of flat. So not sure what they reported, but this is what it looks like. It looks like it's ready to take a rest, frankly. The weekly, I mean, everything looks pretty strong, but it does look like it needs to take a break right there. And the other one was MMYT. This one definitely is heading lower. So there's the short-term down signal, short-term bear signal right there. And it went below 0 right there. There's the medium-term bear signal. Here's the squeeze over here, and it is a bearish squeeze, so it fired to the downside. And you can see the red line is above the green. So this one doesn't look too good. On the weekly, it's been doing great for quite a long time. I remember this one on the top 10 list for quite a while. But it looks like it too needs to take a break. So it may come down to around $90. Right now it's sitting at what? It's at 103. So it could come down to $90 before it continues back higher, or it could go back up tomorrow. Who knows? But on the chart, it looks like things are starting to roll over. All right, let's take a look at Technical Tuesday. And today I'm going to talk about patterns. Recognizing chart patterns. I'm going to go through this very quickly, and then I'll show for those subscribers where they can find it. So chart patterns, I talk about some of these quite a bit, so I'll show you what they look like. They're essentially trend lines with 3 or more points, makes a valid trend. Often use closing prices rather than highs or lows to draw trend lines, since the closing price represents traders' willingness to hold a position overnight. And I like to use closing candles as well, not the little wicks. Uptrends occur when prices are making higher highs and higher lows. Downtrends are when they're making lower highs and lower lows. And I've said this many times over and over. Consolidation is just basically a sideways market. So continuation patterns, there's a few different types of patterns, which I think it talks about here. There's a few, maybe not. So there's a few different types. We're going to talk about each of them. Continuation pattern is a price pattern that denotes temporary interruption of an existing trend, but it is a continuation pattern. So if it's been in a bullish trend, then it's basically taking a break, like what we're probably going to experience here soon, before it continues the uptrend. And if it's been going down, then the continuation pattern takes a break, basically sometimes goes up before it continues the downtrend. While the price pattern is forming, there's no way to tell if the trend will continue or reverse. It can do whatever it wants. In general, the longer the price pattern takes to develop, the larger the price movement within the pattern. That's true of the squeeze too that I've talked about before. So these are some of the continuation patterns. Pennants, oops, sorry, can't click on that. Pennants, I'll show you each of these. Flags, wedges, and triangles are continuation patterns. And then reversal patterns signal a change in the prevailing trend known as a reversal pattern, or a change of character of the chart. Reversals that occur at market tops are known as distribution patterns, and ones that occur at market bottoms are known as accumulation patterns, and I'll show you that in a second. So these are some of the reversal patterns: head and shoulders or inverse head and shoulders, double tops, and double bottoms. This is what market cycles look like. So there's the accumulation phase at the bottom. Then there's a markup phase and sometimes a reaccumulation in the middle. And then at the top, there's a distribution phase. And you don't know if these are distribution phases until it breaks down. So I know I talked about this before, that we might be in a distribution phase, but I also said that you don't know if it's a distribution phase until it breaks below support. Really important. Just because I say it looks like we're in a distribution phase does not mean that we are in a distribution phase. We don't know if that's the case until it breaks support. And certainly in the last few days, that has not happened. So what do chart patterns mean? Traders use them to identify stock price trends, tell you when to buy. Different types of patterns are continuation, reversal, and bilateral or sideways. Strongest pattern is determined by trader preference and methods. The one that you find works best for your trading strategy will be your strongest one. Don't count on anyone else to tell you what they like. Learn the patterns, get used to them, learn them like an old friend, and it takes a long time to do that because each one has a personality, and you'll start to recognize the personalities and you'll gravitate to the ones that work for you. Volume does play a role, often declining during a pattern's formation and increasing when it breaks out. So let's look at each one. Here's a pennant. So you can see it right over here. Looks like a little pennant, and this is a great example because it actually shows what's called the flagpole right there. So continuation pattern with two trend lines that eventually converge. Key characteristics is that they move in two directions, one up and one down. And volume often will decrease, followed by an increase when the price eventually breaks out. The key thing about pennants like this is you don't know which way it's going to break out. However, they usually break out in the direction of the previous trend. And that's what we call the flagpole right here. So the previous trend was up, and then it went down and up, but not as high, and went down, but not as low. And so it kept making lower highs and higher highs at the same time, and then eventually broke out. But it could have broken out to the bottom. But usually when there's a trend like this previously, this is just the stock taking a break, and then it breaks out to the upside. Flags. Keep an eye on this one because I'm going to show you this in a minute as it pertains to the current market. Continuation patterns constructed with two parallel lines, generally a flag with an upward slope or a bullish flag appears as a pause in a downtrending market. So to try to make that clear, if the market has been falling and the flag slopes upward, that is a continuation pattern to the downside. If the market has been going up and the flag goes to the downside, then that is a continuation pattern back to the upside, depending on what the previous pattern looked like. It's kind of counterintuitive, but think about that whenever you see a flag pattern like this, they often will break to the opposite direction. If it's been going down, often will break to the upside. Ascending triangles, so it's a continuation pattern using a specific entry point or profit target, and usually it's a straight line across resistance across the top, and then higher lows sloping upward. So remember, higher lows typically defines an uptrend, but it can't get through the top, the resistance line. Normally, these will break to the upside because this keeps pushing it up until finally it breaks out of it to the upside. But that doesn't mean it always will happen. In this case, it actually broke down. But once it does, it usually will move pretty quick. And descending triangles are just the opposite. So you've got a support line down here, and you have lower highs, which is the definition of a downtrend, but you don't have lower lows. You've got equal lows. These usually do break to the downside, just like ascending triangles usually break to the upside, but they don't have to. They can also break up, and if they do, either one will move pretty quickly. So again, you don't know whether or not the pattern is valid until it breaks out of the pattern. Cup and handles, I've talked about this before, and Investors Business Daily loves these. So cup and handle is basically a downtrend and then followed by a move back up towards the level over here where all of these buyers are tired of it going down and they just want to get out of break even. So they start selling, but there's not enough sellers to overcome the buyers that are getting back in. So it doesn't go down as far as it used to down here. And then it starts to move higher. And then the breakout is when it breaks out of that resistance level and then moves higher. So you can always, when you see something like this, you can put a stop right down here underneath. Here's an inverse head and shoulders. I've talked about head and shoulders patterns, but the inverse works just as well. In this case, it's a left shoulder, a head, and a right shoulder, but it's upside down. So in this case, the potential breakout is to the upside, whereas with a regular head and shoulders, it's the opposite, and the potential breakdown is to the downside. Again, it is not a valid pattern until it executes. In other words, until it breaks out of that resistance, or with a regular head and shoulders, when it breaks out of support, breaks down from support. So always keep that in mind with any of these patterns. They are not patterns until they execute. Double top and double bottom. Here's a really obvious double top right there. We could be making a double top right now in the S&P. That's one reason I'm a little bit worried about that shooting star candle from today, because it went back up and hit those highs again, but did not close above the highs. So that's a double top. And again, you don't know if it is a valid pattern until it breaks through the support level, which is usually right here in this little, looks like an M. So the little middle part of the M, that's where it has to break the support for it to be a valid double top. Same thing with a double bottom. Double bottom looks like a W. And to validate, it needs to break out above that middle little uptrend right there in the middle of the W. So that's double top and double bottom. Wedges, these are actually pretty reliable patterns. So if you see a rising wedge like this, and you can pick them out usually pretty quickly. So the wedge, it kind of like squeezes, going to the upside, it squeezes together and volume goes down. These usually, and very often actually, will execute to the downside. Again, it is not a valid pattern until it breaks down below the support line right here, but usually it will break to the downside. Now I'm going to show you how to calculate the potential target on these in a second. Falling wedge is just the opposite. So it's been going down for a while. Volume declines. It's getting pinched together down here. And these usually break to the upside instead. So they're counterintuitive, but just keep those in mind if you ever see something that looks like this on a chart. That might give you a clue to the direction it might be heading. Gaps, of course, I've talked about gaps. Gaps are reversal patterns. So the price has been moving down and then it gaps up. That just means it closed the day before and it opened higher and never filled that gap. Gaps often, but not always, will get filled. So you can see there's a gap right there and it got filled over here. So many times the stock will come back to where that gap is. And that's why I talk about gap support. That's right in that area. And that's what it did. It's not an exact number, it's an area. And then when it hit that and closed that gap, it went back up. So you can have a breakaway gap forms at the start of a trend, like down here. You can have a runaway gap that forms in the middle of the trend, like right here. And then you can have an exhaustion gap that forms near the end of a trend. So up here might be an exhaustion gap at the end of this trend up here. So you need to really understand which way the stock has been moving to understand gaps. Symmetrical triangles are basically lower highs and higher lows, forming essentially a very similar trend line on both sides. These are essentially bilateral patterns, and you don't know which way they're going to break until they do. So in this case, this one broke to the downside, but it could just as easily have broken to the upside. This is indecision in the market. The market doesn't know whether it wants to push it higher or push it lower, but eventually one of those will win out. And again, it's not a valid pattern until it does. And that's where you would place your, in this case, a sell short order. All right, so how do you calculate the target? The measured move is what it's called. So this is a bullish flag. Remember the flag, it was an uptrend here, and then it went down in a pretty much even way, up and down through a declining trend line or channel. So the way to calculate what the potential target is you measure from the flagpole, so the bottom down here where it started, to the top of the first one where it started going up and down. And that distance you then put to the end where it breaks out, and that's the potential target for that move. Now, what does that mean? Does that mean when it hits the target, it goes down? Yeah, it could. Does it mean when it hits the target, it keeps going up? Yep, that could happen too. It's just telling you that that is probably where it's going to move to. And then you will have to make a decision on what to do when it gets there. Depending on the market, depending on the stock, what it's doing, you can place a stop below there and see if it comes down and takes it out. Or, and if it does, or if it comes down and then bounces and starts back up again, it might be time to add more. But that's how you measure a bullish flag. Here's a bullish pennant. So this one, you kind of got an equal distance up and down. Again, it's the same thing. It's a flagpole all the way up to here. And then where it exits, where it breaks that trend line is what you measure. And then that gives you your target area for a bullish pennant. This is a falling wedge. So a falling wedge is usually bullish. It's counterintuitive because it seems like it's continuing to fall. But if it's falling in a wedge like this, these often will break to the upside. So again, in this case, you take it from the point where it began, where you started these trend lines, and you need at least 2 or 3 before you can really identify a trend line. But the distance is from where it enters right here to the top, to the highest one, the longest one. And that is from where it exits above this trend line where it breaks out, and that is your target area. Same distance as the target area over here. And again, it could just continue, but it just gives you an idea of where it could head to, and helps you to understand what your reward to risk ratio might be on that particular trade. Cup and handle, of course, that I talked about this, showed this before, but in this case, if there's a clear cup and it goes up and down inside of here, usually volume starts to dry up, then it starts to climb up out of the other side. And then when all of these buyers back here are tired of being in it and they want to get out at break even, they start selling at this resistance line, but there's not enough of them to really send it back down again. So new buyers come in, and these older buyers are now exiting. And as the new buyers come in, it goes back up, and the target price is the distance to the bottom of the cup and the resistance line. And then the target is once it does break out, and again, it is not a valid pattern until it breaks out. But once it breaks out, then the target price is usually the same distance as the resistance to the bottom of the cup right there. Head and shoulders are good favorite, head and shoulders. So there's a left shoulder, head, right shoulder. So there's what's called the neckline. That's pretty clearly the support. And again, it is not a valid head and shoulders pattern until it breaks through support. But once it does, the target is the same distance from the head to support of the neckline. You measure that same distance from the breakout, and that's where the potential target would be. Double top, which we might be in right now. We'll look at that again in a minute. But the target for a double top is down to the bottom of the M, the middle part of the M. And then again, it has to break through that for it to be a valid double top. And once it does, then your target is the same distance right there. All right, so that's it for patterns. Hopefully that was helpful. This last one is just a little cartoon from Hedgeye. Hedgeye is a great site for anybody interested. Go check them out. I love their cartoons, though. I love this one in particular because it has my name in it. So are we hawkish or dovish? Who knows? There's earnings. They're picking the bones of earnings. So that's it for Technical Tuesday. I want to show you where you can find these. And what I did was on the website, I just added right here on the charts page. So for subscribers, if you go to the charts page, and right down here, it says chart and candle pattern cheat sheets. It did used to say just candle pattern, but now I've added chart patterns. So if you click on that little button right there, you'll get all the chart patterns and the candle patterns. And it will tell you where to set your stop and where your target is. Help you to, just a little cheat sheet to help you understand patterns. Right next to the one for candles. And the presentation I just showed you is right here. It's a PDF file. So you can go back and review that same presentation that I just now went through. So all that is right there on the website for subscribers. And we can very quickly look at the Magnificent Seven because some of these changed today. So the ones that are highlighted in green just gave short-term up signals. Netflix, definitely. Costco gave one. Palantir gave one today. Microsoft gave one today. NVIDIA gave an up signal yesterday. So anybody that's been waiting to get into these are the signals. Usually it's the best time to do it right when this fires, the same day or the day after, because it will start to continue up. You can see on NVIDIA, it still has a medium-term down signal, but if it continues higher, that will change. That will turn into an up signal. Netflix, the same thing, and Costco, same thing. So you can look at the charts on any of these, NVIDIA, for instance, and you can see that the up signal was given right here. So it's going up to resistance right up here. We'll see what happens tomorrow. Oh, you know what? Let's look at the chart. So there is the down channel. Remember what I showed on that? So this is a flag pattern. So if we take it from here, and let's say this is the flag from this point right here. So that's about 5720 up to 6100. So 6100 minus 5720 is 380 points. And you add that to 6100, and we have a potential of about 6500 where this could go to. Now, it needs to break out of this resistance. Remember, this is not a pattern. Well, it actually has broken out right there. So it has broken out of resistance. So this is a valid pattern. So actually, I need to add it to this one, 5964. 5964 plus, I think I said 380. So that's about 6350 is what the target is on that. So that's what the current S&P looks like. It looks like if it can break out of this resistance level right here, that it could be headed to 6350, somewhere in that area as a target. So we'll see. We'll see if that happens. NVIDIA. So this one has just been going sideways right now. So it needs to break out of 150. And it may pull back. So let's go back and look at SPX and look at it a little bit closer in. Instead of 1 year, I'm going to look at 6 months. So if this is a double top, so we got a top there and we got a top there. So the M, bottom of the M is roughly, let's take it in between these two, roughly about 5,800. So 6,100 minus 5,800 is 300 points. That puts it to 5,500, which is right down here. So potentially that is right down here. That's below the 200-day moving average. So that would be the target if this turns out to be a double top. And remember, you don't know, the pattern does not execute until it breaks below 5,800. So that may not happen. The 200-day is way up here. So actually, that's the 65, I think. Yeah, that's a 65-day. 65-day is up here. So it could come down to this level and go back up. But if it does break below 5,800, and there's a support line right there, which is at 5,850. So 5,850 is the key level right now. If it breaks below 5,850, then it very well could be headed to 5,500. But again, just because I'm saying this does not mean it's going to happen. It may not happen at all. This shooting star candle might not confirm tomorrow. So there's lots of things that could happen. The 50-day moving average is at 59.75. It might go down to there and act as support. You don't know. We don't know until it gets there. But the pattern will not be valid until it breaks below 58.50. So that's the key level to watch. All right, that's it for today. Thanks for watching. Let me know what you think. Please like and subscribe if you want me to continue to do these videos. I will be out of town this week, so tomorrow, I'm leaving tomorrow evening. Tomorrow I will do one, but it will be during the day as the market is open. I will not have a video on Friday, and I will try to get a newsletter out, but I'm going to be away until Sunday. So, but I'll still try. We'll see. But no video on Friday, and tomorrow's will be during the day while the market's open. All right. Thanks, everyone. Have a great evening, and I will talk to you later.